in these fragile markets, anybody, when is it going to implode? That's what everybody wants to know, because what they're trying to do is hide the truth and lie and lie and lie. But understand that if you're counting on the fiat money markets to secure your retirement or anything else that you want to do, you need to rethink it.
Do you feel it? The cracks in the global financial system are growing, and the Treasury markets are at the breaking point. In today's crucial video, Lynette Zang uncovers why the foundation of global markets is shifting beneath our feet, and why you can't afford to ignore it. This is your chance to prepare before it's too late. Let's dive in.
Yeah, the value of the dollar keeps going down. And because what the Fed is really fighting is deflation, so markets going down, real estate going down, things going down, that's deflationary. What they've done is, just since September, they have dropped interest rates a full percentage point. Okay, well, what they're trying to do is inspire more borrowing and spending and generate more inflation, which erodes your purchasing power more. But the markets no longer trust the Fed to do it. So while the Fed is dropping interest rates, oh my goodness, interest rates are actually rising. And they anticipate, meaning the markets, anticipate a 5% interest rate. Why does that matter? Because it means that all of this new money gets a whole lot more expensive, and we have this huge debt wall that is coming due. It's also critical because what we're looking at is the Treasury market, which is the global foundation of the financial system. So if there's problems in the Treasury markets, there's problems globally. Do not make a mistake about that. The 10-year Treasury and the 10-year gilt, which is the British sovereign bond, and you can see that they are both spiking. This is a huge problem, but what can you do about it? Well, the first thing that struck me is the extent to which 10-year bond yields have increased. Just as many central banks on a global level are lowering the interest rate. Uh-oh. That is a battle royale between the markets and the central banks. But the real problem is really in all of those those big bets against interest rates, that in that completely opaque market, we can't see it coming. So you need to make sure that you have your sound money strategy in place. So I want to take a look at the 20-year bond yield, which actually did go above that 5%, the 10-year yield, the 30-year yield, and the 2-year yield. So you remember I told you that when the yield curve inverts, so the shorter term bonds interest rate is higher than the longer term bonds interest rate, that indicates a recession, typically 12 to 18 months. The real danger comes back in when it reverts, which it has. I showed you that. And what they're trying to do is fight off that recession, and I mean they, by the central banks, by lowering the rates to try and get more people to borrow and spend and create new money. And this is just the federal debt held by the public. It's not all of it, but you can see how much more rapidly that debt is growing, and they're trying to do it again. And the markets are going, yeah, you're going to do it at a much higher interest rate, which means all that debt costs that much more. So here you can see, going back to 2008, all of the Treasury debt relative to GDP, which I always like it when they go relative to GDP or inflation adjusted, because what they're trying to do is hide the truth and lie and lie and lie some more. You know what doesn't lie? Physical gold and silver in your possession. That doesn't lie. It runs no counterparty risk. Let me show you this. This goes all the way back to 1960. Then all of those banks grew pretty well. And in 88, we had a peak of 46 of them. And these are the primary dealers, the market makers in treasuries. And we hit a low of 17 in 2008 because of all of the bank mergers that happened during that period of time as the banks were falling apart. Now it's grown, but since 2008, it has shifted on who is buying the treasuries. So who is that? Well, unburdened by the strict regulation imposed on banks, they have flourished amid the growth of highly automated electronic trading. And what we're talking about are hedge funds. There are almost 50 fewer banks which were long-term holders of the bonds, right? So that would help stabilize the prices into the hedge funds, which they're short-term players. They're just looking for a pickup of interest, a little pickup here and there. Well, that makes us kind of vulnerable, doesn't it? And we've seen it actually since 2015 when we had liquidity. So that's the ability to buy and sell easily with not a huge price difference, right? That has been occurring since 2015. We have seen the lack of liquidity spike, even as the central banks have printed all of this money into existence. And understand that once that money is printed, it's still sloshing around the system. So you're seeing all of the stock market go up, but that's just excess money. The value of those dollars, or anywhere you are in the world, doesn't really matter. The purchasing power value, which is the value that matters to you and me, is going down. But understand that if you're counting on the fiat money markets to secure your retirement or anything else that you want to do, you need to rethink it. And I'm not telling you what to do. You have to do whatever it is that you're comfortable in. But we can protect and create that wealth insurance with a sound money portfolio for anything else that you want to stay in. It's critically important. And so you need to take a look. Are you diversified? Are you properly diversified? If you've started your sound money strategy, are you done yet? Get it done. Because the other part that you really need to be familiar with, and the point of gold in this diversification is as a true flight to safety and a true portfolio diversifier. Gold exhibited a low 30-year correlation to major fixed income indexes. So what are those indexes? Look, it's the closest to T-bills, right? But these are a whole bunch of global bonds. So a low correlation. That's why it's diversified, because it doesn't move with that. What that means is it does not move in the same direction as that index. It is inverted, right? So if the bond market goes down, gold market goes up. If the stock market goes down, the gold market goes up. Gold and silver are the true portfolio diversifier. So you need to make sure that you have everything in place. And by the way, gold and silver need to be the foundation. Absolutely. In these fragile markets, anybody, when is it going to implode? That's what everybody wants to know. Well, I don't know. I'd rather be 2 weeks too early than even 1 second. I'd rather be 20 years too early than 1 second too late. Because once it's too late, what are you going to do? There's nothing that can be done.
Thanks for tuning in to this essential update with Lynette Zang. The financial landscape is shifting fast, and staying informed is your best defense. If you found this video valuable, make sure to hit that like button, subscribe to the channel, and turn on the notification bell so you never miss critical insights. Stay prepared, stay informed, and we'll see you in the next video.